Hello and welcome to Martyn Lucas Investor. We are here to cover the Fed's speech. This is going to be a live event. You can watch it later on to see what's happened. But this could give us indications to see if we can confirm there's 3 rate cuts. We have now basically confirmed 2 rate cuts. We're going to see what tone this Fed speech is on. Remember, this speech is actually focused on interest rates, inflation, and growth. So waiting for Fed WALLER to go live. There might be a couple Fed representatives here. So this is the Fed now going to be speaking live on the show. Thank you everyone for tuning in. Oh, we've just got coming on. So thank you everyone for tuning in. Let's go straight to it. It's starting up. If everyone could do one favor and hit the like button and subscribe if you haven't done so already, that would be amazing. Let's see what's going on.
I'm Tom Keene, and
oh, very quiet.
Some of the notes, and I'm going to do a record quick intro because every moment is important. This morning, we welcome you. It is the C. Peter McCullough series on international economics. We welcome you. We will have Q&A. I think the governor's dreading that, but we'll see how that goes. Important comments from the governor. I want to make clear here, the press is here, and we thank them for their attendance today. This meeting is on the record. When we get to Q&A, we will fold this into members in attendance and also out on Zoom.
Oh, there's going to be a Q&A as well. It's going to be great. The volume is up, so please, I'm going to reduce my volume. You take your volume up.
Of this event, the curiosity over the views of Governor WALLER. I'm going to give you one anecdote because my history with Bloomberg is, who are these guys? It's like Butch Cassidy. Who is this guy? And I just want to explain the seminal moment where Christopher Waller became who he is today. He was in an accounting class.
Is this a bit better, guys?
And the professor was ancient and literally would put the slide on the tray, and he had a putting green where then while he was lecturing, he would sit there and putt, and then he'd go to the next tray. He said, I don't want to do this. That's accounting. We're not doing that. And that's when he became the beginning path to the economics that he is
How about now? Is
for.
this even better?
So without any further ado, the governor of the Federal Reserve Bank, Christopher Waller.
Everyone, please hit the like button, subscribe if you haven't done so already. This is the Fed speech. I hope everything. I've manually adjusted the volume. This is us manually trying to get it better for you. So I hope everything's better.
Well, good morning. Thanks for showing up. I was here, I think we checked just this morning, I was here in January of 2023 and had a wonderful time, and I really appreciate being back. So thank you, Tom, and thank you to the Council on Foreign Relations for the opportunity to speak to you today. Since the Federal Open Market Committee's FOMC last meeting on September 16th and 17th, economic data have tended to support my view of a labor market that is softening.
Ooh,
and inflation.
This is a great speech, guys.
Temporary tariff effects that is running fairly close to the FOMC's 2% target. Based on what I know today, I support continued easing of monetary policy from its current setting, which I judge is moderately restricting aggregate demand and economic activity. But I also see a conflict right now between data showing solid growth in economic activity and data showing a softening labor market. So something's got to give. Either economic growth softens to match a soft labor market, or the labor market rebounds to match stronger economic growth. Since we don't know which way the data will break on this conflict, we need to move with care when adjusting the policy rate to ensure that we don't make a mistake that will be costly to correct. I believe that how that process plays out in the coming months will have a significant impact on the path of monetary policy. Resolving this conflict has been complicated by the government shutdown, which has delayed important economic data that policymakers and the public rely on to judge economic conditions. Although private sector data alternatives are available and are very helpful, and they complement official statistics, they are less informative in general when they stand alone. The delay in the September employment report in particular makes it harder to know whether the labor market is continuing to soften or is stabilizing. The shutdown also delayed today's retail sales report for September, which would help show if household spending is continuing to support solid economic growth in real GDP, or if there are signs of slower spending that forecasters have been expecting for
This
some
is a
time.
super important speech. No one's covering it. Hit the like button, guys.
Releases on consumer and producer prices were also delayed. We will get them. Data that is important in judging the impact of higher import tariffs and progress towards the FOMC's price stability goal. The administration has recalled some Labor Department employees to complete and release the consumer price inflation report on October 24th in time to inform the FOMC's policy decision 5 days later. To deal with this lack of public data, I spend a lot of my time talking to business contacts, whose views help me form my outlook on the economy. So far, that input tends to support, rather than resolve, the contrast we have seen between strong economic activity and a softening labor market. Employers indicate to me that there was some further softening in the labor market last month, while retailers report continued solid spending, with a bit of caution from lower income households. In the balance of these remarks, I will examine whether information we have on economic activity, inflation, and the labor market, and what it implies for monetary policy. While I feel confident, based on what I know today, that monetary policy should take another step towards a more neutral setting at the FOMC's next meeting, the path of appropriate policy beyond that point will be influenced by how the conflict between data on economic activity and the labor market is resolved and the expected path of inflation. While there are times when data are consistent and paint a clear picture, the economy is vast and complex. And it is quite often the case that some of the data we look at will point in a different direction from other data and make that picture of the economy fuzzy. Almost every month, I need to use some judgment in sifting signal from noise in the economic data. It is just part of the job of economic forecasting and policy making. I don't have any alternative. I have to do it. Less often, but often enough, the conflicts in the data are consequential for the outlook. For example, if you recall in the first half of 2022, the data were creating a big puzzle. GDP was contracting for 2 straight quarters, yet the economy created 2.7 million jobs. Now, normally that would have been called a recession. But if you're creating 2.7 million jobs, no one's going to think you're in a recession, even though GDP was telling you that. So these conflicting data on the performance of the economy complicated the decision on how to set the policy rate. And I believe we are facing a similar problem today. I have been referring to the surprisingly strong data on economic activity, so let's start there. After real GDP expanded 2.8% last year, it slowed in the first half of this year. GDP, after smoothing through the modest contraction in the first quarter of this year and robust growth of 3.8% in the second, grew around 1.6% in the first half of the year. This pattern of GDP growth is partially a result of consumption growth that showed exactly the same pattern. Slower growth in spending and GDP made sense based on the restrictive setting of monetary policy at that time. But it was stronger than many expected with the imposition of sizable tariffs. And after not observing the effects of tariffs on household spending in the first half of the year, many thought it would show up in the third quarter. Yet the data we have for the third quarter indicate that growth has actually accelerated. Looking across all the available data, the Atlanta Fed's GDP Now model is projecting another quarter of GDP growth close to 4%.
This is very important for analysis at the end. Hit the like button, guys.
Private sector forecast has a prediction of 2.5%. Even if the published estimate is closer to 2.5%, that is still not consistent with a labor market that has barely created any jobs since May. One sign that GDP may be expanding closer to the lower end of the estimates is that business conditions seemed a bit softer in September, based on surveys of purchasing managers. The manufacturing sector continued to contract slightly. as it has since March. Purchasing managers for the large majority of businesses that are outside of manufacturing reported a slowdown from August to a level that is at the break-even point between expansion and contraction. Something that will affect the growth rate of GDP in the fourth quarter is the federal government shutdown. If it is resolved in the next couple of weeks without major changes in government staffing or funding, the shutdown will lower GDP growth several tenths of a percentage point in the fourth quarter, but then it'll rebound in the first quarter when the government reopens. But if the shutdown lasts considerably longer and does result in permanent staffing and spending cuts, then the drag in the fourth quarter could be larger and the bounce back smaller. Let me now turn to inflation. 12-month personal consumption expenditures, or PCE inflation, which is what the Fed uses for its inflation target, rose in August to 2.7%, and core PCE inflation was up to 2.9%. Now, both are above the FOMC's 2% target. Now, compared with an earlier era when inflation ran close to 2%, from 2002 to 2007, core goods inflation is now running a half a percentage point higher than it did then. And research by Federal Reserve Board staff and others indicates that most of this is due to the effects of tariffs. Though a partial pass-through of tariffs will permanently raise the price level, tariffs will only temporarily affect the rate of inflation. Now, the FOMC does not target the price level, but it does target 2% inflation over the longer run. Since I expect tariff effects on inflation to fade in the coming months, what matters for monetary policy is the rate of inflation outside of tariffs. And estimates by Federal Reserve staff indicate that this underlying rate of inflation is running fairly close to our target. With market-based measures of longer-term inflation expectations apparently well anchored, and a soft labor market keeping down wage demands, I judge that inflation is on a path to a sustained level of 2% and should not itself be a barrier to moving monetary policy toward a more neutral setting. Now, given this benign view of inflation, I believe the ultimate disposition of the labor market will be the more salient factor affecting monetary policy in the months to come. As I said, the broad message of all the labor market data is one of weakening demand relative to supply, even with the substantial lower net immigration and a decline in labor force participation this year. And we got very similar info from the Beige Book yesterday of a relatively soft economy. Monthly job creation went from an average of 111,000 in the first quarter to 55,000 in the second quarter, and the latest official report for August was 22,000. The numbers are nearly the same for the private sector, which I often consider a better guide to the overall labor market. Furthermore, based on an estimate of the benchmark revision to the level of employment in March of 2025, and taking that forward for the rest of the year, when those revisions for this period are released next year, it is likely that payroll employment has actually fallen on net since May. If the economy is growing as healthily as spending and GDP data indicate, I would expect that employment would recover in the coming months to a positive but not high level, reflecting the reduced labor supply that I just mentioned. However, if spending and GDP grows slow and better reflect an economy that doesn't seem to be creating jobs, then the labor market may continue to soften.
More Fed speakers coming as well.
In the absence of the September employment report, we must rely on other data for a sense of what happened last month. Alternative labor market data for September present a mixed picture of how things are evolving. Private sector employment, tracked by the payroll services firm ADP, points to continued slowing in job creation. ADP estimates that private employment fell 32,000 in September after falling 3,000 in August. The company said that job creation continued to lose momentum across all sectors in their data. Data on job postings on the online job search firm Indeed also point to a continued gradual reduction in employment, but don't signal a significant downturn in hiring. Indeed's opening data are useful in the absence of the September jobs report because over time they line up closely with another report for September that may be delayed. The Job Openings and Labor Turnover Survey, or
This is
JOLTS.
very bullish. This is completely live. There is Fed
available through
more
August
coming,
have been
Q&A,
echoing what I've
plus
been
my
hearing
full
consistently
analysis.
from my business contacts,
Smash the like button, guys.
which is that firms are holding on to workers but not backfilling positions or planning to expand hiring. Total separations are quite low by historical standards, and both layoffs and the number of people voluntarily quitting their jobs are low. At the same time, the hiring rate has continued to fall, and outside of the pandemic recession, it is at its lowest level since 2012. This situation may appear fairly stable, but I find this no hire, no fire stance by employers a bit ominous. It is possible that many employers who found it hard to find qualified workers during the pandemic are especially reluctant to let them go, even in the face of considerable uncertainty about demand and staffing levels in the future. But when those workers do leave, they are not being replaced. Businesses have reported that hiring and expansion are on pause. But some of my business contacts say that they can't wait forever and will soon have to decide whether more or fewer employees are needed. Both business and consumer surveys conducted by the New York Fed signal an upturn in expectations about future levels of unemployment. So looking further ahead, I can see two possible paths for the labor market. On the one hand, we could see a stabilization in the labor market. In essence, it could move toward the story that consumption and GDP seem to be telling. Despite more than 3 years of very restrictive monetary policy, spending has proved very resilient. Most forecasts call for a significant step down in the pace of PCE growth this year, but that sizable slowdown just hasn't happened. One factor that may help explain this is that the savings rate has been revised notably upward, resulting in higher disposable personal income and more support for spending. It is possible that resilient spending will help convince businesses to maintain staffing and even begin to expand hiring in the coming months, bringing about a recovery in job creation. Another possibility is that R-star, the interest rate below which monetary policy stimulates demand, is higher than most forecasters believe, and maybe even the FOMC. If this were true, then the current setting of monetary policy may not be holding back demand and economic activity very much, which would have implications for how quickly the FOMC should lower the policy rate. Those are some reasons why the labor market may strengthen and validate the story being told based on what we know so far about economic activity in the third quarter. On the other hand, there are some reasons why the labor market continued to soften while GDP growth steps back down to a more moderate pace. For me, one of them is how dependent consumption is on a relatively small number of high-income consumers. The highest earning 10% of households are responsible for 22% of personal consumption. The top 20% of households account for a third of all spending in the US economy. Their share of stock market wealth is even more skewed. And lots of research shows that these consumers are fairly unaffected by higher prices, higher unemployment, or a slower economy. The bottom 60% of earners in the US represent 45% of consumption and only 15% of wealth. Their spending decisions are much more likely to be affected by prices, financial conditions, and job availability. I have heard from business contacts that this group has been affected by higher prices this year and is already changing its spending plans to find better value. That view was echoed in the Federal Reserve's recently released Beige Book, which is a survey of business contacts.
We covered this yesterday.
The consensus view across the country is that while consumer spending inched down in recent weeks, spending by high-income households on luxury travel and accommodation was strong. Lower and middle-income households continued to seek discounts and promotions in the face of rising prices and elevated economic uncertainty. So at what point do higher prices prompt a larger cutback in spending by middle and lower income households? Now, another reason I often hear for a greater weakening in the labor market is that artificial intelligence, or AI, may reduce demand for workers. Over the past few months, retailers have told me that they will reduce employment next year because of efficiency gains.
Very important. Stay with me with this.
Firms are saying that they can and will replace workers in call centers and IT support with AI robots. This echoes what I read recently about the largest private employer in the United States, Walmart. Walmart says that despite expectations of solid sales growth, it plans to hold net employment steady for the next 3 years as AI replaces or transforms different roles in the company. That said, while AI adoption is widespread among large firms, it is not nearly as common among smaller firms, which account for a large share of the US economy and employment. So the impact of AI on total labor demand is still uncertain. The implication of this for monetary policy is not so clear. Monetary policy is designed to address cyclical fluctuations in the economy. But if AI constitutes a structural shift in the demand for labor, so labor demand is permanently lower in a significant way, monetary policy is not an effective tool to deal with that. So overall, I see AI as a short-term risk for the labor market, but in the long run, as I talked about in a speech yesterday, AI should bring productivity gains that will eventually be welfare improving. So where does this all leave monetary policy? Tariffs have modest effects on inflation, but with underlying inflation close to our goal and expectations of future inflation well anchored, I believe we are on track toward the FOMC's 2% goal despite recent readings. As a result, my focus is on the labor market, where payroll gains have weakened this year.
That means rate cuts.
May well be shrinking already. Labor supply has surely reduced what would be a good monthly rate of job creation. But I am very skeptical that it could be zero or a negative number. Based on all the data we have on the labor market, I believe the FOMC should reduce the policy rate another 25 basis points at the meeting that concludes October 29th. But beyond that point, I will be looking at how the solid GDP data reconcile with the softening labor market. If GDP growth holds up or accelerates and the labor market accordingly recovers, it might be an indication that policy is less restrictive than I thought, and the pace toward a neutral setting for the policy rate should be slower than I expected at the last FOMC meeting. What I want to avoid is rekindling inflationary pressure by moving too quickly and squandering the significant progress we've made over the last 4 years taming inflation. On the other hand, if the labor market continues to soften or even weaken and inflation remains in check, then I believe the FOMC should proceed to reduce the policy rate toward a neutral level, which I personally judge is about 100 to 125 basis points lower than it is today.
That's 4 or 5 rate cuts.
The labor market has been sending some clear warnings lately, and we should be ready to act if those warnings are validated by what we will learn in the coming weeks and months. Thank you very much for your time.
That was incredible. I've got the full analysis. I've got everything he said there, the key quotes. I think he's going into a Q&A now, so this is going to be even more important. But some of the things he says was, I support continuing easing of monetary policies. He is very dovish. Policy is moderately restrictive, aggregated demand and economic activity. That suggests that rates are too high. And at the end, you saw he said 100 basis point cuts, 150 basis point cuts. That's 3 or 4 or 5 rate cuts. This is Fed WALLER, one of the Fed representatives. He votes whether we get rate cuts or not. We're going into the Q&A now, so stay with me. We might have Jerome Powell later. We will have another Fed representative. All you guys can do is just keep watching, hit the like button, subscribe if you haven't done so already. I'll put the newsletter link in the live chat as well. Please do subscribe to that as well.
Has to get out there and speak.
Well, one of the criticisms that's been leveled at the Fed for a long time is we engage in groupthink. Every policy decision is a 12-0 vote, there's no dissents, and that if you're all going to do exactly the same thing and think the same way, we don't need 19 of you, we need 1. But what I always try to point out is it's through speeches and public speaking that everybody presents their views, and you can go out and listen, and they're not the same. So all the public speaking, the speeches are the way for us to show a diversity of opinions and thought about the direction of policy. This is a good thing. It's not a bad thing. Despite people saying it's a cornucopia of noise, it's actually signaling where people stand. When you come to the meeting, and I always try to stress this to people, we have to make a decision every 6 weeks. We do not get to kick the can down the road. And what that implies is that to get a reasonable, consistent opinion, we have to kind of compromise. You have to come to a decision. And that's why our votes are often 12-0, 11-1. It's because we all understand we have to compromise somewhat on our positions to have a clear, consistent policy setting for markets and the American.
We're getting insights to the Fed we never got before.
University of St. Louis had a small book out of his time with Greenspan, a term at the Fed, and he was heated about the consensus vote, the need for consensus. Should we be more like the Bank of England, which seems like a fist fight every 6 weeks?
Yeah, I'd like to avoid the fist fight every 6 weeks. But, I mean, I personally think there's nothing wrong with dissents. It's a way to communicate differences in policy stances. You know, the whole complete consensus largely comes out of the Greenspan era, where it was like, if you have a 12-0 vote, there's no doubt about what policy should be. Everybody agreed with the chair at that time, and that kind of tradition continued. But as the Bank of England has showed, there's no point of having 19 of us if we always do the same thing. So at that point, what's wrong with having a few dissent?
Can we get 105,000 subscribers? Can we do it?
It shows anything about loss of faith in the chair or not the right policy, but that's the whole point, is to say, look, I'm on this committee to have my own independent view and make these points. And that's what people are doing.
We welcome all of you again, particularly worldwide, with Christopher Waller into this audience. Ed, can I call on you first for the first question in a bit? I'll let you come up with it, but I think we need to hear from Ed Cox.
I'm giving you a little time to think of it.
He's got a little time to think about it, and I don't want to get in the way of his good first question. I'm going to ask some questions about the speech. I got to keep the assembled press happy, or they won't show up again at Council on Foreign Relations. But I want to come out of this with a little bit more knowledge about who is Christopher Waller. We'll get to that in a minute. Number one question I get, the unemployment rate's 4.x%. Is a 4.x% unemployment rate now the same as a 4.x unemployment rate when you were at Washington State?
No, I think this is where we're in this unusual situation where we have this kind of zero net immigration instead of roughly, say, 400,000 a year. Actually, people leaving the country. And this is kind of, I've said this before, it's masking this decline in labor demand. So just think about, if it's all immigration and you have a decline in labor supply, then the following things should happen. Employment will go down. Wages should be bid up if you have a labor shortage. Vacancies should go up. Quits should go up. That's what you should see with a very tight labor market and declining labor supply. When did we see that? 2022. 2021. That's what we saw, and that was a very tight labor market. If things are driven by a decline in labor demand, just kind of thinking about labor supply as constant, you'll see jobs fall. There'll be downward pressure on wages. There'll be downward pressure on vacancies. Quits rates will fall. That sounds to me more like what we're seeing in the data. So all that's happening with all the labor supply stuff is it's kind of masking the weakness of labor demand. And I've seen some estimates that if you had just kept the labor force participation rate where it was earlier, unemployment would be 4.95%.
Okay, well, that's an important touch point. I would suggest 5% is a much bigger number than 4.9%. Do you see an immediacy at the central bank and among the staff that the real unemployment rate is 5-ish and not 4.x%?
Well, that's where you got to take a position on what do you think the labor supply is doing. Is it fine that it's 4.3? Because the fact that people leave or drop out of the labor force, that's just a natural part of the economy. And therefore 4.3 is exactly reflecting things. Or do you think like I do, which is like, we're seeing falling labor demand, and if it wasn't for this decline in labor supply, we would be hurting. And there'd be no doubt about cutting rates. Absolutely no discussion about it. So that's where they were in this weird thing. We've never seen falling labor demand with a big fall in labor supply at the same time.
The bell has gone, the stock market is open.
I can remember.
And that speaks to the technology. I'll get to that in a minute, and the AI thing. You mentioned 100 basis points, 4 rate cuts, 5 rate cuts, maybe is modeled in. You have to see what happens out there.
5 rate cuts.
Quote, despite more than 3 years of restrictive monetary policy, how many rate cuts do we need to get Christopher Waller away from the dreaded R word, restrictive?
Well, that's what I said. You have to kind of pick what you think is the neutral rate, which means you're neither stimulating or contracting the economy. That's the simplest way I describe what the neutral rate is. I just typically look at the SEP, the Survey of Economic Projections, and the median is around 3%. So for the committee as a whole, if it's 3%, right, you know, you've still got 125 basis points to go to get to neutral if everything starts coming back closer to target. And that's where I think things are going to go.
But the challenge, as you allude to in your speech, and I'm going to be aggressive here, I think of John Edwards and Two Americas. Basically, there's two R-stars out there right now. There's an R-star for the haves, including everyone on Park Avenue assembled, and there's an R-star for the have-nots who are flat on their back, including farmers in your Dakotas. Yeah. I mean, there's two R-stars. How do you manage that forward in a divided America?
Yeah, so that's actually an interesting way of thinking about it. I never have. But typically when people talk about R-star, I mean, how many interest rates are there? It's not like there's one that this is the unique R-star. So I gave a speech last May 2024 on R-star in Iceland. And I always have to look at it this way. For me, R-star is a policy rate. I control reserves in the banking system. What's the closest substitute? Short-term liquid government debt. So for me, that's the real R-star that I should be attention, not the return on capital, not the return on AI, not the return on corporate debt, the return on safe liquid government debt. That's the R-star I look at. And that's driven by global demand for treasuries versus the global supply of treasuries. That's how I view R-star. I mean, your point is actually a very good one, that what's restricted, if you think about R-star as being restrictive, it's more restrictive for some groups than it is for others. That's probably always true. It's not just now. But it seems to be very stark this time that upper income groups, everything's fine, wealth is booming, the stock market's booming, they've got no problem financing stuff. I hear this from retailers. We pass tariffs through to high income customers. They don't bat an eye about it because they can afford it. Low income households, they can't pass it through. They'll walk out the door. So that's the tension, right. Again, one of these tensions that we have kind of this dichotomy in the economy between the upper income groups and the lower income groups.
Off the script, off the speech, three esteemed market economists that I spoke to all said the same thing away from a typical monetary policy speech. They're looking at QT, QE, the state of our monetary policy forward, and the Fed's unique balance sheet. Give us an update on where you stand with the Fed's balance sheet and the end of quantitative tightening.
Yeah, I mean, I think we're at the point where we run in ample reserves. I gave a speech in July on our balance sheet. We run in ample reserves to ensure that there's sufficient liquidity in the banking system, in the financial markets, that people don't have to, at the end of the day, go scrambling around looking for nickels and dimes in the couch to cover their reserve positions. That to me is idiocy. So you have ample reserves. The reserves are there. Nobody has to spend the whole evening looking for money under the cushions. We're about at that point. We had an excessively large balance sheet due to quantitative easing. We ended that. We've been on a quantitative tightening policy since May of 22. And we're basically back to where we think we should be just for ample. All the QE stuff is taken out in terms of how much liquidity. It still has affected the composition of our balance sheet, which was part of my speech I gave in July. Right. QE really distorted the maturity structure of our balance sheet, and our next choice, even though we get the level right, our next job is to try to get the composition right, and that'll take some time.
I shared this stage with Jason Furman up at Harvard, boring kids in Ec 10 in basic economics, and he had a brilliant tweet the other day where he said, we need to fold in the wealth effect into our consumption. You have brilliant consumption numbers in here of the haves, the upper decile. They're trading one block over on Madison Avenue. Explain the wealth effect and how it boosts monthly consumption. You mentioned luxury travel and others. How wealth effecty is America right now?
Yeah, so I mean, if you go back to some basic economic theory, one kind of rule of thumb is for every $1 of wealth you get, the real interest rate, say 3%, 2%, your consumption should go up by 2 to 3% for every dollar in wealth you get. So like 2 or 3 cents for every dollar of wealth. That's what we mean by the wealth effect. Now those numbers also mean that wealth increase is permanent. It's not a one-time. If it's just a one-off, right, you're not going to change your entire consumption path. So this is always kind of the challenge with the wealth effect, because it's not that big of a number in terms of a dollar increase. It's only like 3 cents of consumption. But that also has to be permanent. It's not like a one-off and then comes back down. So wealth effects often sometimes are smaller than that. But the run we've had for the last few years,
Right.
that's looking pretty permanent and pretty big. It's not just a $1 increase. It's
I'm going to squeeze in a couple more questions here. This one's from the press. David Gura gave me this question over at Bloomberg News because he's vicious in his questions. Should we get rid of the dots?
That's a good question. I mean, I personally have doubts about whether we should have the SEP at all. But I've been told that, what are you trying to hide then? Why would you take them away? Why would you not be as transparent about
What would happen if the dots went away?
Well, you'd kind of be back to 2011. And then, you know, we would say that. Now, you could change the dots. I personally believe you should get rid of the calendar dating, get rid of the long run numbers, and just say, look, what's the next optimal policy over the next 6, 12, 18 months? That's as good as we can do. So then it's a rolling number, and you get away from this crazy thing. It's like, wow, there's 3 meetings left in the year. How many more rate cuts this year? Who cares?
The media, we wouldn't have a job.
So if I said, okay, at the September, he said, here's how many over the next 6 months,
Right.
that's what the focus would be, not the end of the calendar year. So I would do that and then get away from the long run stuff. Just the best we can do is 6, 12, right, maybe 18 months out, any kind of forecast. We don't have any genius insights over everybody else on Wall Street who does this. So that would be one of the critical things I would do, is change the calendar dating and shorten the horizon that we actually do it.
One of my hallmarks is, who are these guys? Literally like Butch Cassidy. And so we're going to find out who Christopher Waller is. I mentioned you were an accounting major and you got bored because the professor was putting, so you switched to economics. The Waller of 1991 is a spectacular 13-page paper, I think it is, on prodigious game theory. And what he didn't know in 1991 is he would be describing the game theory of 2025. I'm not going to get you in trouble with the Secretary of Treasury right now, but I'm going to review this. You set up in 1991, off of James Baker's word bashing, of where administrations bash the central bank, and there's coercion involved, the title of the paper, bashing and coercion. You sub out strong administrations and weak administrations. No, I'm going to not ask you what this administration is, but I want to take it forward to the present day. If we have bashing and coercion, and we have to be ex ante, we're trying to get out front of the debate, the Fed's trying to glean what's going on, or we go true ex post, literally in a Georgia school, where we wait for the data to come in. How does the bashing and coercion affect the monetary challenge of ex ante versus ex post? Do we become more ex post with an administration going after a central bank?
Well, like I said, I wrote this paper back because at the time there was a lot of discussion about central bank independence and institutional design. And the kind of presumption was, once you pick the central banker, that's the policy, and every other external influence just kind of went away. And I was kind of looking around going, that's not what I'm hearing. That's not what I'm seeing back in the 80s, right? There was a lot of criticism. And so this idea of Baker's was, look, the administration can push the Fed one way or the other by publicly criticizing the Fed. Now, when I wrote this paper in 1989, 1990, I didn't think I'd be the one receiving it 25 years, 30 years later. So it was, when I reread the intro the other day, I was like, wow, what was I thinking back? So, but I mean, that is kind of the situation. And it's not just the current administration. This has been done forever. I mean, George Bush bashed Greenspan in
Burns and
92
LBJ.
costing him the election. Criticism had come out. This was a norm until basically Bob Rubin came along, and then it was like, don't talk about the Fed. And that kind of became the rule through a sequence of administrations until President Trump came in 2018, started criticizing the Fed more publicly than had been done in a long time.
Does it change the behavior of a given central bank if we have bashing? You're trying to get out front. The public, the media want you to be out front, omniscient, have a crystal ball. Or do you have to slam back to a massively ex post data dependency because you're getting crushed by whatever the executive branch is, whatever the nation is?
Yeah. I mean, at the end of the day, this is what I tell everybody. I just go to work and I try to do my job the best I can. That's all I can do. Right? A lot of this is just out of my control. You know, whether the administration's views drive people to push one way or the other, and you know, I can't speak for anybody else, but I just try to do the best job I can using the theory that I know, the models of the economy that I use, and the data that I use. So, you know, the call I made in June, which was I was saying the labor market is not as good as it looks, and I was accused of being political. August 1st, that suddenly didn't look so political. The data came in exactly the way I said it was going to. So what sometimes looks like people say, they were interpreting this as purely a political position. Suddenly the data said, maybe it's not political. Maybe it was actually the right call. And so that's how I kind of think of this. You can always look at something and interpret it as political when it's not. That's kind of the problem in what we decide and what we do.
One more question. I'm going to go to the floor and also out on Zoom worldwide with the Council on Foreign Relations. I want to get this one question in. I have to ask, with your heritage of the Dakotas and the Old Northwest, how bad is it for the farmers right now? Soybeans is the news, but French Hill down in Arkansas is telling me, guess what? They're flat on their back. Yep. Report on that, please.
Well, back in the first Trump administration, there was tariffs on China, and China immediately responded by not buying U.S. soybeans. And I was at the St. Louis Fed. Some of the biggest soybean producers were in our district. I heard this. We had barges of soybeans lined up on the Mississippi River that were never going anywhere. And they only have a certain shelf life before they rot, and they're gone. So we saw this. China was, I think, don't quote me exactly, but this is in the ballpark, but China was sort of bought like 75% of US soybeans. Even later when some of this came off, soybeans never recovered. China was only buying like 30, again, don't quote me on the exact, but like 35%. And now it's back down to basically zero. So they've just shifted their entire supply chain to Brazil and South America, and they never came back. And so that's the one thing you want to be a little careful of, is just because the supply chain gets disrupted and then you reverse something, it doesn't necessarily mean it comes back. Once it's changed, it's changed. So yeah, soybean farmers are typically getting hammered
and I'll
by China not buying their stuff.
I've seen the new Foreign Affairs magazine. It is brilliant. Shannon O'Neill with a great article on supply lines, which to me is the discussion in Q1 next year. Edward Cox, please, sir, with our first question.
Ed Cox, Committee for Economic Development of the Conference Board. Governor Waller, your excellent presentation. I appreciate it very much about the data. But there's several mega things out there for which the Fed is not responsible that I'm sure are in the background, are part of your consideration. And that's the extraordinary deficits, fiscal deficits going forward, and the value of the dollar. Could you explain how those might enter into your considerations as to what monetary policy should be?
Yeah, we have a kind of a long-standing view that we don't, praise or criticize fiscal policy. We take it as a given for doing our own job. But when you're running 6% deficits, 3% primary deficits, we know that that's just not sustainable in the long run. How long is the long run?
Full analysis after this. I've got all the quotes. I've got all the information. Stay with me. Make sure you hit the like button and you are subscribed. Let's get the subscribers up to 104,000, 105,000. We can do it during the show. Let's see if we can do it.
Think about R-star and government debt, which is the closest thing that should matter for me, and reserves. It's a race between the growing demand for U.S. Treasury debt and the growing supply. For the last 40 years, demand has outstripped supply. And what does that mean? Prices go up, yields go down. At some point, if that reverses and the supply starts exceeding demand, the only way you're going to get the markets in the world to hold this stuff is you lower the price, which means the yield's going to go up. So for me, having good, stable fiscal policy is the best way to ensure that you don't have that happen. But again, this is not under my control. That's up to the Congress, White House to think about fiscal policy. And that's it. That's just my view on it.
Question over here, sir.
Mark Rosen, Adventure and Growth Capital. Governor Waller, you talked about AI, and you said that you thought short term it could have some risks for the labor market, long term was good for productivity. But a lot of forecasters are predicting that it will be negative for the labor market longer term, that it will reduce jobs. How does that impact monetary policy? How does it impact your dual mandate? And how do you think about it generally?
Right, so that's what I was saying. Is this a structural or a cyclical phenomenon with AI? So if you think about labor demand and employment, just over time just grows with the economy. What I worry about is AI being a structural, is there's this one-time permanent drop in the level of demand. The question is, does it continue to grow at the same rate as before? In which case it's just a level effect, employment growth and everything will continue on into the future, or does it drop and then it just stays flat? It not only drops in the level, but it has a lower growth rate of employment. I, as a policymaker, cannot do anything about that latter case. If it's just the fact that there's this kind of cyclical movement in labor demand, that's what I'm designed to have some influence over. But if it's a sharp structural drop, lowering the Fed funds rate 50 basis points isn't going to overcome that. And that's what we're trying to figure out is going to happen. Now, in the past, whenever we've seen technological change, I gave a speech yesterday down at Amazon, you see jobs going away. You know which ones are going to go away, but you never know which jobs are coming. And usually there's a kind of enough of a gap where the jobs are slowly going away, new ones are coming on. This time what I worry about is so fast, it's happening so fast that the jobs go away faster than we can figure out what the new jobs are. The new jobs will show up. I have no doubt about that. It's just the timing may be a little more disruptive than technology we've seen in the past.
Thank you for that question. I forgot to ask that. You saved me there with that question. Here's a footnote from this speech this morning. Technology that improves labor productivity leads firms to demand more labor, not less. A huge body of America doesn't agree with that. And to your point on innovation, with the Nobel Prize, a celebration of the last 48 hours of Schumpeter and McCraw's prophet of innovation, this new innovation, the gains are going to go to a narrow group, or do you think they will, this is a cliché word, they will diffuse out across America?
Well, the history of technology is that they do diffuse. I mean, one of the things I pointed out in the speech yesterday, if you look back to Karl Marx's theory of capitalism, machines, robots would replace labor to produce all the output, everybody would lose their jobs, be unemployed, there'd be this mass army of the unemployed, there'd be a social revolution, capitalism would die, and we'd have a socialist utopia. That doesn't happen, right? I mean, when capital goes up, machines and technology go up, it makes labor more productive. And firms like productive workers. And that's why they want to hire them, because they don't want to keep their output constant. They want to produce more. And they need both of these things to produce more output. This is what we've seen in the history, certainly of the US in the last 200 years. The capital stock in the US is 7 times larger than it was in 1950 in terms of machines, equipment, everything. The unemployment rate is exactly the same. So employment grows with technology. It doesn't go negative with it.
But to the president's point, and arguably his election, a huge body of America feels let down. We had productivity, we had capital deepening of an extraordinary amount, and the jobs went to China. That's his theme.
Yep.
With AI, are we going to replicate that in some unknown way, and the jobs are going to go to you name the place?
Well, even with the China shock, total employment in the US has grown ever since the China shock. It hasn't gone negative or fallen. Just go look at the employment rate. Go to Fred, my favorite data series. Pull up employment, look what it does. It just goes up. So yes, there are reallocations, jobs get lost and they go somewhere else or they get eliminated, but that's my point. New jobs, new things came up, people reskill, go into new areas. So when the China shock was hitting manufacturing, we had a whole IT, software, phone, technology information technology that created thousands and millions of jobs.
Is Fred an unfair advantage for the St. Louis Fed? Do they wake up every day different than any other bank?
Fred is one of the greatest.
Just going to let you guys know I've got a full analysis. I've got all the quotes from all the questions. So stay with me. I am going to give it to you at the end. So stay with me. We're literally live with this event. Please do hit the like button. Please do subscribe. If you haven't got the newsletter yet, the link is now in the comment section and it's the first link in the description. We are trying to get 105,000 subscribers live on the show. Can you guys make it happen? Let's go back to the Fed Q&A, and I've got all the key quotes. So if you haven't understood what they're saying, I've got it all ready for you straight after.
Here we go. Ma'am, please.
Hi, Ginger Cutler. I'm a term member at CFR. Governor Waller, just what you just said about how unemployment is the same as it was in 1950 and the China shock didn't really necessarily affect employment. I guess I want to harken back to what you said about where wealth is concentrated in the hands of Americans, right? And how you said that the bottom 60% of households own 15% of wealth and 45% of spending. I'm curious how that figures into what you just said about unemployment being the same as it was in 1950 and the China shock ultimately not really having an effect on the labor market. I'm curious how inequality factors into that.
Yeah, so like I was just trying to get at with employment, you get sectoral shifts. Some sector goes down, some other sector goes up. In my speech yesterday, I said, look, when automobiles came up, if you were making saddles or wagons, your jobs were going away. But those same skills got transferred over to producing chassis for cars, making car seats. The same skills, they just had to transfer them. So those jobs went away, but other jobs came up that took their place. That's why you can't just look at one sector and say, oh, that's going to kill the entire economy. I don't believe that's going to happen with AI either. In terms of wealth and income inequality, this has been an issue in the US for the last 40, 50 years. There's been a tremendous increase or a reasonable increase in wealth inequality, income inequality. For me as a policymaker, I have one instrument. I can't deal with inequality. It's really not in my toolkit. I can't say here's an interest rate for this group, as Tom was saying. I can't say here's an interest rate with that R star and here's an interest rate with that R star. That's not in my set. I have to look at the aggregate. It's really my only choice. Mm-hmm. Can I look at these discrepancies and think how I might want to lean one way or the other? Sure, I can. You know, we kind of got criticized for that before with our last framework, that we were kind of leaning a particular way. There's nothing wrong with it. It's just there's very little we can do about it. And that was my issue with our last framework. I could care about this, but there's very little I can do with it for particular groups.
I think we have a question here in the digital world.
We'll take the next question from Chris Thomas.
Good morning, Governor Waller. Thank you for the time today. Ex-Intel, ex-McKinsey. Now I help global companies think about their global footprint and where they put advanced manufacturing facilities. And the constant refrain is that no matter how high the tariff, the US is just completely uncompetitive, and now it's the most expensive place in the world to do business, especially if you're building something. To what extent does this matter for the growth and success of the US economy, and is there anything that could be done about it? I've heard that even if it's 100% tariff, it's still cheaper to manufacture in Taiwan or Vietnam or Japan or Korea or China than in the US.
Yeah, I mean, this is way outside my wheelhouse, I have to say. You know, trade policy, you know, particularly worrying about one sector over another, manufacturing versus others. This is just something I can't make those decisions. That's what the president got elected to do, and he's following through on his promises. Whether you get stuff onshoring or not, I don't know. We'll see. We did learn something with the pandemic, that supply chains stretched across the globe are pretty fragile. And there was a lot of emphasis on getting nearshoring, maybe not onshoring, but nearshoring as a result. Over time, you know, if tariffs were big enough, I'm pretty sure you'd bring your factory back. There is a price at which you will bring it back. It's not infinite. So that's what I don't know. We'll see how this all works out, whether there's a lot of incentives to bring stuff back or not. Or whether the people that, you bring these jobs back, whether people want to do them or not. I mean, in the US, we've moved into much more of a service sector mentality. And the idea of screwing lug nuts on a tire for 8 hours a day is not something most Americans typically want to do.
Well, I'm not going to ask you about bananas and tariffs, because I don't think we're growing bananas. Sir, over here, please.
Hi, Andrew Watros with Morgan Stanley. Governor Waller, thank you for your comments. I want to ask you to say a little bit more about what you are intending to convey with the phrase "to a more neutral stance of policy." In a sense, if you're restrictive, just cutting once is moving to a more neutral stance of policy. Or is this describing sort of a process where over several meetings you have an idea of a range in mind that is more neutral, and you're describing a process of moving towards that range?
Yeah, I'd say it's the latter. It's really the process. So if you're at neutral and you think you're restrictive and your policy rate is set up here, what's going to cause you to bring it down? You think inflation's coming back to target? You think the labor market is either stable or weakening? You want to kind of bring it back towards neutral. It doesn't mean you go below and you want to stimulate the economy. Things would have to really get bad. We're not seeing that in the labor market, that we want to go below neutral. Or I'm not seeing it. I can't speak for anybody else. But the debate right now is about inflation. Inflation's running 3%. It's way over our target. It's been above target for 5 years, 4 years. Why are you lowering rates? So you have to say, what is the outlook for inflation? And that's what I've argued, that any tariff effects are going to be temporary. You look, this is a classic line in central banking, you look through those things. You think about what is going to be inflation 12 months from now, not when the next 12 months. So that's what I'm doing. And in that world, I see inflation coming back down to target. I see a softening labor market. So I want to bring things back to target. I don't want to go below target right now because inflation is above target.
In Q&A, we go to tenths of a percentage point. You were talking whole numbers up there. You say 2% is where the Fed is right now. What is the latest thinking you see around the raging debate to take a Taylor rule, look at the output gap, look at NAIRU and all the rest of the mumbo jumbo, and plug in a more normal 2.2 or 2.4 or 2.6% run rate versus the decades-long hope for a 2% inflation?
Oh, change the inflation target?
Yeah.
Yeah, I mean, there's always a good argument or debate about should you pick a point or pick a range. A lot of central banks in the world, they run with a range. They don't seem to have big problems with that. You know, like the Bank of Canada has a range of 1% to 3%. So, you know, there's often a question of you're just as happy with 3% inflation as 1%. No.
Should we be?
No.
Should we be?
They want 2, but they're not going to do crazy stuff to get it to 2. That's the key point. You'll get there. You'll take your time, but you're not going to do drastic policies to drive it to exactly 2. I think 2 is a good thing. I'll give you my spiel on it. What's the real value of having a 2% target with a particular price index? It holds you accountable. If I just said, inflation in general, somewhere between 1% and 3%, there's a lot of loose things that go on in there that I could always slippery slide, say, I did my job. What are you talking about? That happened with the money growth targeting back in the early 80s. Yeah, M1 was pretty good, but M2 was lousy, but next month M2 was.
Remember how the world stopped? I think it was Thursday at whatever it was, 3:30 for M1, M2,
Oh, yeah, it's money growth targeting. So I like 2% because it holds me accountable. Okay, now, you want to hold me accountable because it's 2.2 instead of 2? Come on. That's where a range kind of helps. I always like to tease my friends and things is, in the year 2000, if I had told you the Fed would keep inflation between 1% and 2% for a decade, everybody in the year 2000 said, that is a phenomenal monetary policy success. But because it ran 1.7, we didn't hit 2, it was a failure. Think about that. 1.7, not 2, was a failure. But if I'd asked you before any specific 2% target, you said 1 to 2, that's amazing. That is phenomenal monitoring. So that's the danger with the 2%. It's so precise that if you don't hit it, you start saying you're failing and hitting your target. That's why I actually kind of like a range myself.
I want to talk one final question here from me about the culture and the fabric of America and our economics. There is such a conceit and bias and a distrust back to 1907 or even before of 3 zip codes in Manhattan.
We can
or
do
maybe
it.
a quarter
Who
from
hasn't subscribed
Washington
yet?
up
Go
to
on your other
Boston.
account. Go on
You
your wife's account.
represent
Subscribe
a
to
part
the
of
channel. Let's get to
America, some
105,000.
would say the
Full
backbone of
analysis
America,
after as well. I've got
from
everything,
Bemidji,
all the key
the
quotes.
Dakotas, Bemidji, all the way out to Washington State and then to St. Louis. How would the Federal Reserve System
Also, make sure you smash the
change
like button. What's going
under
on? No one's
Chairman
hitting the like
Waller,
button.
given that cultural geography versus every day the East Coast certitude? It's the heritage of the modern economic Fed.
Well, I mean, this is one of the brilliant aspects of the design of the Fed. I've studied the structure of the Fed for 40 years now. The whole idea was to say, look, you need some political accountability in DC, but you want to have a lot of this outside of DC. That was the typical grassroots, get people away from DC, talk to the American public. I always say we're the one government agency that has contact with all parts of the U.S. through our 12 districts and all the branches in those districts. Everybody can come talk to a president of the bank. They go out regularly, speak to the public. You can come talk to them. You can have a conversation with somebody. I mean, the only other institutions that have that kind of contact are the IRS and the post office. And we typically don't want to have them knocking on our door. So that's one of the big advantages of the Fed in our structure of having people on the outside. There has been debates forever of moving more political accountability to the Fed or moving it away. Sometimes people's views shift back and forth depending on what the situation is. But I believe the basic structure that we have has served the country well by representing all the country in the decision-making process, just not a few handful of elites in Washington, D.C. So that, I think, is important. I would say, like I said, for me, one of the critical things, I'd change the SEP. I would encourage dissents. I'm not somebody who's afraid of like, oh, if you're dissenting against what I'm pushing, that lowers my confidence or my credibility.
It'll be so much better for us. 5-4 votes. It'll be, it'd be. I highly recommend lots of dissents.
Yeah.
It'll make the Fed show better.
Well, I just think that's the whole point of it. That was the idea of the structure, was you put 19 members so you get this diversity of views from around the country coming in, different points of views. If everybody comes in, no matter what part of the country, no matter what the situation is, and you always say the same thing, we don't need it, Just have 3 governors and that's it at the board and you're done with everything.
Governor Waller, thank you for joining the Council on Foreign Relations.
Thank you.
Okay, here we go. Full analysis. This was all live. Let me give you the full analysis. So I've got it here. Taking notes throughout this. I'm going to give you all the key points. I'm going to look at the market. I'm going to wait to see if Jerome Powell comes on as well. So that is waiting over there. I'll keep the volume on in case that changes. Let me come to this actually. Here we go. So some of the notes from the initial speech and then from the Q&A. So very, very dovish. This is Fed Waller, one of the Fed representatives who votes on the policy cuts, etc., etc. Firstly, I've just put this into the newsletter. So if anyone hasn't got the newsletter yet, please do hit the like button. Not the like button, hit the like button as well, but get the newsletter. It's the link in, it's the link in the live chat, first link in the description as well. So make sure you've got the newsletter every single day. We give you the everything you need to know about the markets. So a few things in his first statement. He said, I support continued easing of monetary policy from its current setting. That is clearly dovish. Remember, dovish means more rate cuts. And he is dovish with that statement. He's backing more rate cuts. He's literally said that. He then said policy. I'll make this into a video actually. Let me just make this into a video for anyone who hasn't tuned in. So breaking news on Martyn Lucas Investor. We have now got rate cuts confirmed. We've got Fed Waller coming out. We've just listened to his whole speech. I think it was about, how long was this whole speech? About an hour long we listened to his speech, and now I've summarized it for you. So let me tell you exactly what Fed Waller said. Some very interesting points. He had a full speech and then a Q&A, and from that Q&A, what I'm doing is giving you the main points. He said, to begin off, he said, I support continued easing of monetary policy from its current setting. That is a clearly dovish tone. He is backing more rate cuts. He then went on to say, policy is moderately restricting aggregated demand and economic activity. He is saying that the rates are too high, and that is a slightly dovish tone. He then said, something's got to give. Either growth softens or the labor market rebounds. The Fed sees conflicting data. Neutral signals caution before big moves. Remember, these are all the key points. I'm not just going through his speech. He spoke for an hour. I've got all the key points so you don't miss a thing. So he then said, we need to move with care when adjusting the policy rate. He is cautiously dovish with that statement. He said slow and steady cuts, not aggressive easing. He does not support sudden massive cuts, 50 basis points every meeting. He supports a slow and steady cut, which is what we want to see. Remember, we are looking at the Fed Watch tool now, and it's become more bullish because we're looking at a rate cut on the 29th of October. Remember, we're going to cover it live, so make sure you are hitting the like button and subscribing. It takes 1 second, it's free. Just make sure you have just hit the like button and subscribe. We'll be covering all these events. Remember, no one was covering this event. This is us covering the event because this is the important stuff that matters. Then in December, it looks like we're getting another rate cut. And in January, the odds are just swinging in our favor now after this speech. It wasn't this way before. After this speech, now 3 rates are looking likely. In the next 3 FOMC meetings, October, December, January, we're looking at 3 rate cuts coming our way. Underlying inflation is running fairly close to our target. He is suggesting that inflation is no longer a barrier to cuts. That's not a reason they should be keeping rates where they are. He then says inflation should not itself be a barrier to moving monetary policy towards a more neutral setting. He confirms inflation is contained. Remember, all of these are dovish. He then says monthly job creations fell from 111,000 to 22,000. That signals a labor weakness. That's dovish for rate policy. Remember, there's 2 mandates: inflation under control, jobs market under control, and unemployment staying low. If there's labor weakness, that means they had to cut rates. So again, when he suggests that jobs creation is falling that much, that's a signaling a labor weakness. He then said, I find this no hire, no fire. Remember, that's what's going around in the markets right now. No one's saying they're firing people. No one's saying they're hiring. So this is the stance right now from companies, is this no hire, no fire. So he says, I find this no hire, no fire stance by employers a bit ominous. That's basically him warning of hidden labor softness. That is a dovish bias. He then goes on to say the labor market has been sending us some clear warnings lately. Remember, if he's worried about the labor market, they'll be cutting rates, or he's one of the people that has an influence on that. So labor conditions are worsening. He is supporting easing. He then went on to say, I believe that FOMC should reduce the policy rate another 25 basis points at our meeting. He is supporting that rate cut. So yeah, that's direct confirmation that we are in for a rate cut. He then said, if GDP growth holds up or accelerates, the pace towards neutral should be slower. That is when he's actually not as dovish. He's a bit balanced. He says cuts could pause if growth stays strong. So he's saying if there is enough growth in the market, if things are looking good, they don't actually need to cut rates. So that's a bit more of a balanced approach. So we'll be looking to see if growth is holding up or accelerating. If it is, then they might do a few rate cuts and then hold. He then says, if the labor market continues to soften, the FOMC should proceed to reduce the policy rate. Strongly dovish. More cuts ahead if jobs weaken. So if we start getting that jobs data back, again, the government's in shutdown right now. Once we start seeing any movements down in the jobs data, we are looking at more and more rate cuts. A neutral level is about 100 to 125 basis points lower than today. That's a direct quote from him. That is very dovish. He is hinting about 1% plus of total cuts. That's about 4 to 5 FOMCs of rate cuts, 25 basis point rate cuts. So that is a very dovish statement from Fed WALLER. He then says tariffs will only temporarily affect inflation. This is what's going around now, which the market's more confident in. Tariffs do cause inflation. They do have an effect on consumers, but it's more likely to be a one-time effect on inflation. So the Fed are not going to take it into account. So downplays inflation risk. It's a dovish reassurance. We should be ready to act if labor warnings are validated. So he does keep the door open for faster cuts, market friendly. Yeah, so he does say if labor warnings come out, and we are and what Waller has always been a bit worried about the labor market, and he's right about it. He has been proven right. He says if we continue to get these warnings, we should start cutting rates faster and faster. Then we did basically go over to a Q&A. That first Q&A, some of the statements taken from that. Remember, stay with me. It's only going to be another 3 minutes. I'm going to tell you everything else you need to know from that Q&A. If you do, just take 1 second to hit the like button, subscribe if you haven't done so already. The first link in the description is the newsletter. Do subscribe to it. It is a 1-week free trial. There is a free plan. There is a monthly plan. The monthly plan will be going up in price if you haven't signed up yet. So do consider that as an option as well. So what happened in the Q&A? Well, this is when he gave us some more insights. He did say unemployment at 4.6% is masking a decline in labor supply. So the jobs market looks stronger than it really is. Dovish supports rate. So he's saying we're looking at 4.6% now, but it's actually a whole lot worse underneath. Again, that supports rate cuts. If participation hadn't fallen, unemployment would be about 5%. So there is a hidden weakness behind the surface. Again, dovish. We are in this weird thing we've never seen. Falling participation, falling jobs. So structural labor softness. Dovish signals concerns over growth. Remember, each of these being dovish is more and more reasons why we will expect the Fed to cut rates. He then said the neutral rate is around 3%, so we still have 125 basis points to go. He literally gave the target. Clear policy guide. Dovish confirms route for multiple cuts. Not many people are covering this event, but this is where all the juicy bits are. They are looking to get down to 3%. That's about 100 and 125 basis points. That's about another 4 rate cuts. So there we go. He then said policy is more restrictive for some groups than others. Remember, this is not me coming out and saying buy. Rate cuts doesn't equal market pumping. If the market's already in a bubble, it doesn't equal market pumping. So just because I'm giving you the news on what dovish means and what he said about rate cuts doesn't mean this equals markets pumping, just to let everyone know. Policy is more restrictive for some groups than others. Acknowledges inequality. Dovish focusing shifts from lower income pressure. Remember, if they're cutting rates, it means there's a concern in the market. It doesn't mean everything's going well. That's why they're cutting rates. It means they need to cut rates because something's going wrong. So I am bullish about rate cuts. That could have the last euphoric run in the market because of these rate cuts. But also we could still get a crash. And then because we're getting rate cuts, the recovery could be quite large, quite significant as well. So that's how I'm looking at it. I'm not looking at this and going out after this speech and buying every single thing out there. So anyway, the policy is more restrictive for some groups than others, acknowledges the inequality, focusing shifts to lower income pressure. We heard him speak about how the lower 60% of the US, how there's a lot of inequality because they feel the pressures of the economic policy a lot more. And the rates. He then said wealth is booming for high-income households, but low-income households can't pass on costs. It describes a two-speed economy. Again, realizing that rate cuts will help the lower-income households more. He then said we're basically back to where we think we should be on reserve. So now this was very interesting. He basically said, on reserves, remember this is quantitative tightening, quantitative easing. Right now they've been on a tightening cycle since 2022. He then implied that quantitative tightening is ending. Liquidity pressures are easing. We could be ending up in quantitative easing. That's when the Fed starts printing money and starts buying stocks, treasuries, all that sort of stuff. So his quote was, we're basically back to where we think we should be on reserves. We think. He didn't say I think. He said we think. That means they could be ending the quantitative tightening cycle. He then said, I just go to work and try to do my job with the data I have. Anyway, that's the Fed independence. There was one more Q&A when he started asking the audience. Some of the quotes from there was, what do you think about Trump's announcement at 3 p.m.? We haven't cover that yet. That'll be later. I'm just reading the comments. Okay, anyway, AI could be a structural one-time permanent job drop in level of labor demand. He was asked about AI. He's worried AI might permanently reduce jobs. Dovish implies weaker long run. Yeah, but then he said very much that you can get a one-time drop, but you expect it just to continue, just like when we went from horses to cars. Everyone found new jobs. It was just different to what they expected. He then said, if it's a sharp structural lowering of the base, policymakers can't do anything about it. He acknowledges limits in monetary policy neutral, but signals that rate cuts can't fix structural job loss. He then, the next point was, this time I worry it's happening so fast, the jobs go away fast, then new ones appear. This is talking about AI. So he does warn about a short-term disruption going on right now, which could cause the next crash in the markets, guys. This AI stuff is not just something you hear. If it's here to stay, we are in an AI bubble. If it starts taking away a lot of jobs, then we are in store for a recession. And then when we start seeing all the efficiencies, then we can start pumping again. That's my thoughts about 2026. I think we'll have a big recession and then a resurgence. And sort of with this quote, it's quite interesting because he says, this time I worry it's happening so fast, jobs go away fast, then new ones appear. So he is talking about that they might be starting to get ready for emergency rate cuts and supporting the economy if that occurs. He then says technology makes firms more productive, and that's why they want to hire, not fire. Reassures that AI may eventually be a net positive for employment, neutral to slightly hawkish long term. So I do think that's the point. Short term, we might get lots of people losing jobs, but because the efficiencies start coming into place, and it makes people more productive and makes the companies more money, then they'll use that. The companies will use that money to hire more people. So we'll be fine long term, but short term we might get a recession because of it. He then said employment today is the same as it was in 1950s, despite automation and China shock. So historical arguments against AI's driven collapse, neutral, keep longer term optimism. He says, look, we've been through this before, the Industrial Revolution, China's taking the jobs, and we are still growing. AI is not a new, obviously AI is new, but we've had things like AI before. Wealth inequalities have risen sharply, but there's very little I can do about it with interest rates. He recognized inequality, but says it's outside the Fed's control. Neutral limits scope of monetary activism. Moving towards a more neutral stance is a process, not a single cut. He confirms the Fed's plans, multiple gradual cuts, not just one-off moves, dovish for the market. And then he talks about the 2% level. He says that I think the 2% target is a good thing, but we don't need drastic policies to drive it exactly there. So that's the full summary of today's Fed Waller speech. There'll be 2 videos up here for you guys to have a look at. So do check them out. There'll be the newsletter as well. Please do subscribe to the newsletter to get all of this information directly to your inbox. But until next time, take care of yourselves and each other. I think that's it. That's going to come out as a video. I think that's it from the event. Yeah, we're not getting Jerome Powell out. So if he does come on, I'll come back with a live. So make sure you are subscribed so you can get it. No, Jerome Powell hasn't come out. Did we get 105,000? Oh, 46 more. Can we get it? Please do subscribe if you haven't done so already. The market's opened. XRP is now coming down. Gold is going up to all-time. It was just hit all-time highs once again. The S&P 500 is being volatile. Expect volatility. Go watch the earlier video. Go subscribe to the newsletter because I gave you all the ways to make sure you make money during this market and all the mistakes you should avoid. But thank you everyone for tuning in. You're going to be going to the extra channel now. You can continue the conversation, wait there, and then we might see if there's any more speeches. I'll let you know in there. So this will take you automatically to the extra channel. I'll give you the link to the extra channel as well. Remember, that's the second channel that if you've missed anything, you can go back and watch it there, and you can stay up to date with what's going on. So I'll give you the link for the extra channel. Again, we're live every trading morning, 2 hours before the opening bell. If you're subscribed and you've got your notifications on, you'll be able to catch us live. We might be covering Trump later on with Vaz. So keep an eye out for that. Let me quickly go to comments, see if there is anything I've missed. Let me just give you, this is next. This is the extra channel next. That's where we're going next. There you go. Let me pin that. Let me just go through some. I'm going to go to members only mode. If members have any questions, you can ask your questions. If anyone wants to become a member, I'll give you the link as well. Customize. Let me go to members comments mode. Subscribers can still watch, but we're going to go to members mode. If you haven't got a membership, here is the membership link. You can get membership for $2.99. You can also get our newest membership called Electrum. Every day we go, every Sunday we have a trivia night. There's a small group of us. We do the trivia. You win prizes. We do all your chart requests. Leverage. So yeah, it's always a good fun. This is an example. Money to increase. Oh, using limit orders only. Little snippet of our Sunday show, then we go through all the charts. So do consider becoming an Electrum member. You get all the benefits of bronze and silver. Let me go back to Bloomberg and answer some of members' questions. Members, if you have any questions, let me know. Let me go back as well. Oh, Angel, you've become a member. I saw someone did a 10 membership giveaway as well. Thank you so much, whoever did that. I think someone gifted. Oh yeah, Charlie, you gifted 10 Martyn Lucas memberships. Thank you so much. And please, everyone who got a membership from Charlie, please do thank Charlie for your membership. You know, it's a great chance now. If you've just got a free membership, all you have to do is upgrade to Electrum, and you're getting Electrum for the price of bronze. So that's always great. Thank you, Charlie, for sharing the love and inviting people into the family. Let me go through some of these questions and end the stream. So the two-speed economy has been killing me since about 2018. I couldn't spend thousands. Now I spend nothing and can't save $1 barely. I've also gotten raises about 10%. Yeah, it's very, very tough. Thank you for sharing your experience. Songs for Space. David Hensley says, okay, because I can't find that anyway. I think that's false information. What's the false information? GQ Patrol. I think that big well just opened a short again, not looking good. Yeah, I wouldn't. A lot of people are just farming for clicks now. Again, it's too late now. That whale, whoever it was, is not going to just come out and get everything right. I think you can't just trust them now. The first move is probably going to be their best move because they knew the information, in my opinion. Now it's they could be doing all sorts to try and clear the money or whatever they're trying to do now. So even if we did have the information, I wouldn't just go off it blindly. XRP struggling. Kimberly says, Sensei, will this cause a larger bubble in the market? If the stock market goes up for another 5-10%, yes, that will be a larger bubble in the market. We've lost that. Let me go back to the S&P 500. Thank you, very kind of you, Charlie. Yeah, very nice. Nada, one of our new members. Thank you, Sensei. I was playing the video at 1.5x to catch up with your report. Brilliant, Kimberly. I love it. Thank you all for tuning in. We're going to go straight to the extra channel now. Remember, live every day. Remember, sign up for the newsletter. I don't know why anyone wouldn't have signed up by now. But I do have to remind people because it's always a new audience every day. And I don't want anyone missing out on the information. Thank you all. Keep an eye out on the channel. We're going to the extra channel now. It's been a great show once again. I appreciate every single one of you coming in and spending your time with me. Remember, it's these events that are important because it's when you understand more behind the scenes. It's not always the one that everyone's watching. This one, very few people were covering, but it was probably the most important one we've had in the last month. So it's great to get this information. And again, some people might say it's boring. Why are we covering this? Well, the reason is because it's probably the information no one's really looking at, but it's the underlying information that's important. Earlier in the show, go check it out. The previous show, we talked about the six reasons retail investors lose money and how to avoid them. So check it out. Until tomorrow, take care of yourselves and each other. Bye-bye.